Okay, so to get some energy for this next video, I had to take a white chocolate and cheddar savory cookie, a cranberry and jam swirl oatmeal cookie, and a peanut butter and marshmallow cookie with a big bottle of milk to give me energy to finish this one. Okay, so here we go. Hi, so I'm coming to you from a cafe called Hole in the Wall here in Century City Mall in Manila. So I had to take some of those cookies and milk to get some energy to talk to you guys tonight. So anyway, let's get started. So the topic tonight is, should I use a 2555 in the expat exclusion, or should I just use foreign tax paid, which I always call FTP, and 1116 without the exclusion? And like I said in the last video on 2555, all expats know they can use an exclusion of some sort, and they're usually not sure about how much, but it's always around 100,000. Usually they know that. So what most expats don't know is that you don't really have to use the exclusion at all. You can actually let the tax return just calculate as if you're still in the United States and come up with a tax that you owe, and use the foreign tax paid in your country of residence to pay the bill. If you're in a high tax country, that will provide you some more benefit actually, because if China's tax rate is 45% very quickly at a very low income level, and you pay full tax in China, then you're gonna end up covering your US tax bill way more than you need to, because the tax rate you're probably in is 28% or so in America. So the Chinese tax that you've already paid would cover the tax due on your US tax return, and even if you used the exclusion and it was zero tax, and under both methods they were zero tax, the foreign tax paid method would benefit you more, because any excess of, say, Chinese tax paid above US tax owed on the US tax return can be carried forward for 10 years. So this is a huge benefit. So if you worked in China for 5 years, your US tax rate was 28%, you paid full Chinese tax, you would have a credit that would roll forward every year in your US tax return that would roll forward for 10 years there, that you could use against your income tax to pay that bill. So if you left in the 6th year after living in China for 5 years, you moved back to the US, I would be talking to you about, hey look, I think you should file exempt for federal tax withholding for, depends on how big your credit is, but let's just say for 1 year, 2 years, and pay your tax bill with the credits to use them up. So if you move back, that's a benefit that you can use to pay your income tax bill, and that's a huge benefit. And I often help clients to amend that part of their tax return, because what I've also learned working in this area the last 5-6 years in expat tax is that normally there's like a 3-year statute of limitations for the IRS to look at your tax return or to amend your return. But this foreign tax paid area, 1116, form 1116 in the tax return, can be opened up and amended 10 years back, and you can change it, amend it, etc., because it's got a 10-year window. That's the only part of the US tax return that can be changed like that for that long a period. And that's a benefit. I can go back, you know, it's 2014 right now, I can go back to 2005 if you just used exclusion and you didn't do these foreign tax credits right, and I can open it up again. Of course the IRS doesn't want to give you the money, and they're slow to pay, but at the end of the day they know they owe you. And I've had clients, they had to wait a year, year and a half, but they eventually got the money. Another situation like that is, okay, so you have a client who didn't pay any foreign tax, and he gets caught, and he has to go back and pay. This one client had to pay $120,000 US in back Chinese taxes. And then we opened up his last 5-6 years of the same years in the US tax return, and we amended them all and used the Chinese tax paid as credits against what he owed and asked for refunds. So it took a while. It took about 1 year, 2 years, but we eventually got some money back from him for him. So 10-year credit carry forward for foreign tax credits. We have, this is where the expertise of the accountant really comes in. You know, TurboTax pretty much sucks, for expat tax. It's fine when you're in the US, but I have corrected so many returns for clients who use TurboTax, and they couldn't, I think I could file using TurboTax, but I would have to figure out how to manipulate the software to make it do what I wanted it to do, and there's not enough fail-safes built in under the expat tax return method, or doing your expat tax return in TurboTax. There's not enough fail-safes built in, so if you make a mistake, you really don't know if you made a mistake, and TurboTax is not going to auto-correct you. So I think that's a risk, doing your own return if you're an expat in TurboTax. Of course, it's fine if you're in the US, I think. I also used TurboTax before in the US when I wasn't working in tax areas. But most accountants have heavy software that they're going to be able to switch back and forth and look at, okay, this client has this situation, he's got all his income, he's got all his deductions entered, etc. He's got all his dependents entered, he's got his tax situation, then he can flip back and forth. I can flip back and forth between the foreign tax paid method and this 2555 method, and that is pretty effective. You can't really do that in TurboTax. So I think the expertise of the accountant in that case really helps you a lot. You can say, hey, look, under this method, there's this credit, carry forward for 10 years. Under this method, under 2555, we still don't pay any tax, but there's no carry forward. The only caveat for this is that if you choose one method, you can't flip-flop back and forth every year to benefit you. So if you choose the foreign tax paid method, you got to stick with it for 5 years, and you can't really change it back to the exclusion method until 5 years of tax returns have been filed. So if you're going to stay, that's why I asked the client, what's your plan? Are you going to stay in China for the next 2-3 years? Are you going to move to Russia? If you move to Russia, then maybe I'm going to use the exclusion because it's only 13% flat tax in Russia, and you're not going to have a carry forward. Guys in Russia, Americans in Russia, they always have to top up and pay an extra part of their tax between, say they're in 28% tax bracket, they got to pay between the 13% in Russia up to the 28% in America. The only way to lower your tax in America if you live in Russia is that, for the foreign tax exclusion, you get, for 2014, you get $99,200 plus any housing you paid in rent above $15,000. So the only way to really lower that becomes your exclusion. So the way to lower your income tax paid to the U.S. is just to live better. So I have one client, Moscow's high, it's very expensive. So I had one client, he was paying, say, $40,000 a year in rent, USD, and we said, well, okay, so let's have you live better and let's increase it to $70,000 of rent. There's a top. You can't pay you can't pay $1 million, but the IRS I think it's about $114,000 in Hong Kong, and it's about $108,000 in Moscow. They're the top two cities, I think. So you got a pretty high range for rent. So you can just live better, and your exclusion goes up, and you owe less U.S. tax. So that is better than paying the IRS for sure. So anyway, I hope that makes sense to you, and I will see you on the next video. Thanks. Bye.